Good morning. Today we're going to cover the Roth Solo 401k. We're going to talk about how it can be made simple. A Solo 401k from my Solo 401k Financial allows for the Roth Solo 401k contributions, as well as voluntary after-tax Solo 401k contributions. Today we're going to concentrate on how the Roth Solo 401k is made simple by allowing for both employee Roth Solo 401k contributions as well as employer Roth Solo 401k contributions, which results from Secure Act 2.0. So that's a new type of contribution. It used to be you can only make employer pre-tax Solo 401k contributions, but now you can make those as employer Roth Solo 401k contributions instead. Let me share my screen here and we'll get started. On a side note, today's presentation is for informational purposes and educational purposes as well. We don't provide investment advice or sell investments or tax or legal advice. As always, you can follow the conversation on my community, which is my solo401k.net/my community. We also go live twice a day, once here at 10 a.m. Pacific time, and then of course, a second time at 1 p.m. Pacific time. Okay, hopefully you can see my screen here. Let's talk about employee contributions first. Employee Roth Solo 401k contributions, that is. For tax year 2025, the employee Roth Solo 401k contribution, also known as the employee Roth Solo 401k salary deferral, is $23,500. If you're age 50 or older in 2025, you can also contribute an additional contribution catch-up amount of $7,500. And there's also a super catch-up contribution of $11,250. That's new for tax year 2025. It only applies to an age group, specifically those who are age 60, 61, 62, or 63 here in 2025. So instead of contributing the $7,500 catch-up for those that fall in that age range, you could contribute $11,250. Note that the catch-up contribution is on the employee side. It's not on the employer side. And of course, you have to have enough net self-employment income from your self-employed business to justify all these contribution types, whether we're talking about employer Roth Solo 401k or employee Roth Solo 401k contributions. And you also can't contribute more than you make. Now, there's a way to indirectly contribute $70,000 of Roth Solo 401k funds for tax year 2025. You can do that by utilizing the Mega Backdoor Roth Solo 401k, which we'll talk about more in a little bit. But the voluntary after-tax Solo 401k contribution is a dollar-for-dollar contribution based on your net self-employment income. You make that to the voluntary after-tax Solo 401k bucket, and then it gets converted to the Roth solo 401k. So you could do a full $70,000 contribution to the voluntary after-tax solo 401k bucket and then convert it to the Roth solo 401k. That's a quick way of getting to the Roth solo 401k instead of making employee Roth solo 401k contributions or employer Roth solo 401k contributions is by utilizing the voluntary after-tax solo 401k bucket. That's what this bullet point here is covering. Now, keep in mind that contributions to a Roth solo 401k are not subject to the adjusted gross income levels like they are for a Roth IRA, meaning that with the Roth IRA, if you make over a certain adjusted gross income limit, you're not going to be able to make Roth IRA contributions. That same rule does not apply to solo 401k plans. Instead, you just need to make sure you have the required net self-employment income to be able to make the contribution up to the overall limit of $70,000. Okay, let's talk about the employer Roth solo 401k contributions as part of the Secure Act 2.0. And let me share a different screen and we'll talk about that one there. Give me a moment. Okay. So employer profit sharing solo 401k contributions can be made as pre-tax contribution or as a Roth solo 401k employer contribution. And again, you're allowed to make employer Roth solo 401k contributions resulting from Secure Act 2.0. That's one of the reasons that the Roth solo 401k is made simple, is that you can contribute both the employer Roth solo 401k contributions as well as employee Roth solo 401k contribution, and those would get deposited to the same Roth solo 401k bucket. So here's an example of a one participant plan. Let's say you decide to make both employee Roth solo 401k contributions and employer Roth solo 401k contributions. Those would get deposited to the Roth solo 401k holding account, aka a bank account or brokerage account under the plan. The calculation for the employer Roth solo 401k contribution is the same as doing the calculation for a pre-tax employer contribution, in that it's a percentage calculation. It's not a dollar for dollar calculation like the employee Roth solo 401k calculation. For the employer Roth solo 401k calculation, let's say your self-employed business is an LLC, tax as an S corporation. Let's further assume that you report 100,000 of W-2 wages from your self-employed S corporation. Therefore, you could contribute 25% of that box one, that $100,000, as an employer Roth solo 401k contribution. So $25,000, since 25% of 100,000 is $25,000. That would get deposited to the Roth solo 401k bucket. Of course, you're not required to make any type of solo 401k contribution. Therefore, you're not required to make employer Roth solo 401k contributions every year. In some years, you may want to make employer pre-tax solo 401k contributions. In other years, you may want to make some employer Roth solo 401k contributions. One item to keep in mind when making employer Roth solo 401k contributions is that it's going to be a tax deduction on your business tax return. So using that example of $100,000 of W-2 wages for a self-employed S corporation, let's say you make a $25,000 employer Roth solo 401k contribution. That's going to be tax deductible on the employer side. So on the Form 1120S, if we're talking about an S corporation. However, it's going to be taxable on the personal side. So a Form 1099-R will need to be issued to report that as an in-plan taxable conversion. I know it's kind of quirky, but the reason individuals will consider making an employer Roth solo 401k contribution, especially if it's an S corporation, self-employed business, is that you get that deduction on the you get that employer Roth solo 401k deduction on the business side. So on the corporate side, therefore reducing payroll tax. However, on the personal side, it's going to be taxable. And we have to issue a Form 1099-R to report that taxable conversion. And we do that conversion tax reporting for our clients who timely request that type of reporting. Since we don't have access to your funds, you need to make sure you complete our online conversion form if you do make employer Roth solo 401k contributions, so that we're prompted to issue that Form 1099-R. So as long as you timely request that, we'll go ahead and issue that for you, or you can work with your CPA and have him or her issue it. Okay, let's take a look at some more items here. Let me go back to the prior page we were sharing. So whether you make employee Roth solo 401k contributions and or employer Roth solo 401k contributions, those will be immediately vested, 100% vested. So you're not going to have to wait a certain amount of time before you can invest those funds. Only the employee Roth solo 401k contribution qualifies for that catch-up contribution we talked about earlier. So that's $7,500 for those age 50 or older, or the increased catch-up amount of $11,250 for those who are age 60, 61, 62, or 63. So employer Roth solo 401k contributions never qualify for catch-up. One good thing about the employer Roth solo 401k contributions and the employer Roth solo 401k contributions is that you can borrow through a 401k participant loan from just the Roth solo 401k funds. So that's another example of how the Roth solo 401k can be made simple, is that you can just borrow 401k funds through a 401k participant loan solely from the Roth solo 401k bucket. Now, as far as transferring those funds out of the plan, even though they're 100% vested right away, let's say you want to transfer those funds to a Roth IRA, you're going to have to meet a triggering event under the IRS regulations, such as age 59 and a half or no longer self-employed, with respect to being able to transfer those out the plan or being able to take a distribution from those funds. Now, just a side note here, going back to the voluntary after-tax solo 401k contributions, even though this presentation is concentrating on the Roth solo 401k, one option if you're trying to eventually transfer those funds to a Roth IRA is that you can make a voluntary after-tax solo 401k contribution instead of Roth solo 401k contributions, and then you can convert those voluntary after-tax solo 401k contributions, once they've been made to the voluntary after-tax solo 401k, over to a Roth IRA instead, if you're trying to get funds in your Roth IRA. Now, the following type of funds, as we touched on already, can be contributed to a Roth solo 401k. So employee Roth solo 401k contributions, catch-up contributions, and employer Roth solo 401k contributions. Let's go over a few other topics here. These are the type of funds that cannot be contributed to a Roth solo 401k. Rollovers from a Roth IRA, rollovers of non-deductible IRA basis. However, you can transfer the gains and a non-deductible IRA over to the pre-tax solo 401k. That's a good way to isolate those non-deductible IRA funds if you're trying to do a backdoor Roth IRA. Let's look at a few rules regarding the solo 401k Roth contributions. So they've been allowed under the IRS regulations since January 1st of 2006. That is the employee Roth solo 401k contributions. Again, the employer Roth solo 401k contributions have been allowed since the passage of Secure Act 2.0. Roth solo 401ks are governed by the same rules as other Roth 401k plans. Let's say you have a full-time employer 401k and you make Roth 401k contributions. The same rules apply to those that apply to the Roth solo 401k. As we talked about earlier, the income limits do not apply to Roth solo 401k contributions like they do to a Roth IRA, where if you make too much income, you cannot contribute to a Roth IRA. Thus, you have to utilize the backdoor Roth. With the Roth solo 401k, that rule doesn't apply. Yeah, of course, you still have to have enough net self-employment income to justify the contribution. Okay, let's see here. We talked about separate tracking of the funds. So Roth solo 401k funds have to be tracked in a separate brokerage account or bank account under the solo 401k. Let's go back to that prior slide here. So here's an example of a one participant plan. If you make pre-tax solo 401k contributions, Roth solo 401k contributions, and after-tax contributions, that's voluntary after-tax solo 401k contributions, you have to have separate buckets under the plan to hold those contribution types. The plan is already drafted to allow for all these contribution types, which means you don't have to make them right away. You can make them throughout the year or down the road. But it's good to know that the plan is already built to allow for all these contribution types. Here's an example of a two-participant plan. Let's say both spouses are self-employed in the same S corporation self-employed business. They both participate in the plan. They would each require 3 separate holding accounts under the solo 401k plan. 3 for each, so a pre-tax, a Roth, and a voluntary after-tax, because you're required to segregate all the contribution sources as well as each participant's funds. That's a rule that applies to 401k plans because it falls under the defined contribution plan umbrella. Okay, let's see if we have some more topics here to cover. Let's do a search here on our website for some other topics. And then we'll go over any questions you might have. Now, keep in mind that you can also make pre-tax solo 401k contribution, and then those can be converted to the Roth solo 401k. So that's another way of an example of how the Roth solo 401k can be made simple, and that you can consolidate all different types of retirement funds. Can I have a Roth solo 401k and a traditional solo 401k at the same time? The answer is yes. Why? Because the solo 401k is considered one plan. You just have to have separate holding accounts under the solo 401k to hold each contribution type, such as pre-tax funds, voluntary after-tax, and Roth solo 401k funds. So it's just one plan that allows for those different sources. Okay, let's look at a couple more items here. So many of our clients will use Fidelity or Schwab, for example, to hold the solo 401k funds for the self-directed solo 401k that we provide. So here's a great procedure for a client that wants to make an employer Roth solo 401k contribution, and they're using Fidelity Investments through their non-prototype brokerage account that we would assist them in opening. They would make that contribution directly into the employer Roth solo 401k bucket. Then they would need to complete our online conversion form so that we collect the necessary information to report that as a taxable in-plan conversion. Because again, employer Roth solo 401k contributions are tax deductible on the business side, but they're then taxable on the personal side. Let's take a look at a couple more items here. How do I report employer Roth solo 401k contributions on my S Corp tax return? So again, they're reported on the Form 1120S of your corporate tax return. They're also reported on line 17 of the Form 1120S. So this is a great post here that goes over that type of reporting. Let's look at a couple more items. So here are the limits for 2024, the Roth Solo 401k contribution limits. Keep in mind that you still have time to open a solo 401k plan here in 2025 for 2024 for those who want to make employer Roth solo 401k contributions. That would be more for an S corporation. If you're a sole proprietor, you can actually open a solo 401k plan here in 2025 for 2024. And if you do it by April 15, you'll be able to make employee Roth solo 401k contributions. Unfortunately, with an S corporation, you're not going to be able to make any employee Roth solo 401k contributions for 2024 if you did not open that plan by December 31st of 2024. However, you will be able to make employer Roth solo 401k contributions for 2024 if you open the plan here in 2025 by March 15, or if you file for an extension by September 15. So the limits for 2024, the employee Roth solo 401k contribution limit is $23,000, and the catch-up contribution limit for those age 50 or older is $7,500. The employer Roth solo 401k contribution limit for 2024, it's 25% of your W-2 wages. When combined, you can't go over the overall limit of $69,000 in contributions to that solo 401k for tax year 2024. Okay, so that concludes the presentation regarding how the Roth solo 401k can be made simple. Let's take a look at some questions here. Okay, we got a question here. I'm a client and had a problem rollover my old solo 401k from Schwab to Tasty Trust account under my new solo plan. Go ahead and send us an email or submit a support ticket. As a matter of fact, I'll take your name down here and we'll send you a follow-up email when I'm done here. It looks like you need some assistance in rolling over an old plan from Schwab to Tasty Trust. So it sounds like you have a solo 401k with us and you want to use Tasty to hold the solo 401k funds, and you want to move over that solo 401k from Schwab to that plan. So we'll take a look at that. Let me jot down your name here, and we'll follow up with you here today. Okay. In 2020, here's another question. In 2024, I had a sole proprietorship and had opened a solo 401k for that business. During the year, I also started with a group of other owners a second business, which is a C corporation, which I'm receiving compensation from board of director fees, 1099. The C corporation has no employees, but are there any other concerns about the C corp rendering me ineligible to contribute to the solo 401k for this business? So let's see if there are any control group issues or affiliated service group issues here. So you've got a solo 401k, you're a sole proprietorship. Now you also are working for a C corporation and you're receiving compensation, but you're getting it as a 1099. So the key here is that you're not an owner in that C corporation. That's number one. Specifically, you want to make sure that you're not a 50% or more owner in that C corporation. That's number one. Number two, that C corporation cannot do business with your sole proprietorship, sponsored self-employed business. So as long as those two rules are met, I don't see any control group or affiliated service group rules. You can also send us an email at business@mysolo401k.net and we can take a look at that more closely. But based on this particular write-up here, I don't see any issues. Okay. Another question here from Michael. Based on your experience transferring admin services from Ascensus, Ameriprise, how long does it take to complete the transfer? Do you complete the Ascensus transfer forms for me? I received the blank forms just to review. Good question. So it really depends, because if Ascensus is also holding the solo 401k funds, or in this case, if Ascensus is the plan document provider and Ameriprise is holding the funds, then the question is, are you going to continue to use Ameriprise to hold the funds for the new solo 401k that we would restate that existing plan to under our umbrella? In which case, it could be a pretty quick setup, because you would set up new brokerage accounts with Ameriprise for the plan that we offer, or you might be able to use that existing Ameriprise brokerage account and substitute our plan documents. So that would be the quickest way. So it just comes down to the particular setup. But let's assume that you would decide to use a brokerage firm like Fidelity to hold the new solo 401k funds that we would offer. You can open up those brokerage accounts at Fidelity online. We'll provide guidance on how to open up those Fidelity brokerage accounts online, and then we'll prepare the transfer form to transfer those funds out of Ameriprise if Ameriprise is holding those funds. So we would actually fill out that transfer form for you, provide it to you for your signature, and we can fax it to Ameriprise, or you can submit it to your Ameriprise advisor for processing. Looks like you're saying that you're cashing out from Ameriprise and transferring to a new Fidelity checking. Yeah, so if Ascensus told you 15 to 20 days, it sounds like somehow Ascensus and Ameriprise are intertwined together, which means that Ascensus is the one that's technically doing the reporting on that plan. So they might be holding it up for 15 to 20 business days. So that's not unheard of. Unfortunately, I've been hearing that that's one of the reasons a lot of people are leaving Ascensus, is because they're not allowing you to process transfers timely, and it's tough to process any type of request with them. So it sounds like you're going to have to wait for Ascensus to release those funds, because only they can release those funds. Again, send us an email if you want to discuss it further. But based on what you're stating here, it sounds like you are having to wait for a census to get through their processing, unfortunately. Okay, well, that concludes today's presentation regarding how the Roth Solo 401k can be made simple so that you can maximize tax-free growth by ultimately letting those Roth Solo 401k funds grow tax-free. We'll be back here again at 1 p.m. Pacific time. Until then, have a good morning.